In Chapter 12, we're going to talk about how companies determine what the hurdle rate is for making investments. And when I talk about the hurdle rate, essentially what we're talking about is the financing cost. Companies need to at least get a rate of return on their investments that are at least as high as the cost of financing those investments. So this is the essence of what's referred to as the cost of capital. So how do we figure out what that number is? Well, we can start with calculating the equity cost of capital. We would use the capital asset pricing model as one of the ways that we could do this. Of course, we need to know what? We need to know beta. We need to know what the risk premium is from the market. And then, of course, we also need to know the risk-free rate of return. But this will provide us with what it costs, or what the equity cost of the company is. So if we have a company, they're using eBay here, the volatility standard deviation is 30% and has a beta of 1.45. UPS is 35% volatility and beta is 0.79. Which one carries more total risk? Well, of course, total risk is measured by standard deviation. So UPS has more total risk. So what is it when we're talking about? We talk about market risk. Market risk has to do with beta. So obviously, eBay has a greater beta, so it has more market volatility than what UPS does. If the risk-free rate is 3 and the stock market is 8%, what rates of return would we expect to get from these investments? The cost of equity for eBay is 10.25%, and the cost of equity for UPS is 6.95%. Why is it different? It's different because of the market risk of the asset itself. So, how can we work our way through this? So, we want to talk about how we might ultimately create the market portfolio. We need to find the total market value of a company's outstanding shares. So, the market value of a company is the number of shares outstanding multiplied by the price of the company. So that's market capitalization. Most of the time, we don't really have a market portfolio. So what we need to do is have a proxy for that. And again, even though it's not the market portfolio, most people use the S&P 500. So that's what we're going to use as the our measurement, or our substitute, if you will, for the market portfolio. Where would you get the risk-free rate of return? Again, most practitioners use 10 to 30 years in Treasuries. It's whatever you have available to you at the time. But again, this is a yield on U.S. Treasuries. We looked that up. You should be able to find the 10 to 30 year rates. What would we use as the historical risk premium? If you remember, this is the difference between the rate of return in the market and the risk-free rate. And again, if we're using historical numbers, right, we need to obviously have some measurement of where we think the market has grown or how it has performed, and then of course subtracting that from the risk-free rate. So let's talk about different kinds of portfolios. The first portfolio we could talk about is something called a value-weighted portfolio. A value-weighted portfolio, you need to find what is the weight of the asset in the portfolio. You take the market value of the asset and you divide it by the market value of all the securities that there are. So that will tell me what the weight is of each portfolio. In a value-weighted portfolio, there's an equal ownership. So it contains an equal fraction of the total number of shares outstanding for each security in the portfolio. So if you kind of think about different kinds of portfolios, a passive portfolio is a portfolio that's not rebalanced when prices change. So this is obviously just going to say, we're just going to let this thing, it's a buy and hold kind of a portfolio, if you will. So what kinds of indexes fall into these categories? Well, there are two indexes that are valuated, the S&P 500 and what's referred to as the Wilshire 5000. The Wilshire 5000 is the valuated index of all the U.S. stocks listed on the major stock exchanges. So again, it's the 5,000 largest companies. Now the Dow Jones Industrial Average, the one that's reported to us every day, that is a different kind of an index. It is a price-weighted index. We want to have a value-weighted index. So again, kind of going back, how can we find these numbers? Well, maybe we could use an index funds. There are mutual funds that invest in the S&P 500, the Wilshire 5000, some other kind of index. You might be able to find an exchange-traded fund that trades directly on an exchange, but it's kind of like stock ownership. For instance, something called a SPDR, SPDRS, is Standard & Poor's Depository Receipts, and essentially this represents ownership in the S&P 500. So there are a variety of ways that we can find the returns on markets. So let's kind of look and see what we have here. This is the S&P 500 excess returns. Goes from 1926 to 2012, and for a one-year Treasury security, right, we end up with 7.7%, and this is 62 to 2012. You can see that the last 50 years of this is a little bit less, so that it's a little bit lower excess return. The 10-year Treasury, 5.9. 3.8% has been most recent. So if we wanted to talk about what is the excess returns versus these securities, let's think about a 10-year security should be somewhere around 5.9%. Now, of course, if you used a 30-year Treasury, it might be actually a little bit higher, maybe closer to around 7% for the 10-year Treasury. So, is there any other way we can figure this out? Maybe we can use historical data, although there's some problems with it. Maybe we can look at and do some calculations based on the things that we actually see. So here we're using the United States historical data. Again, we talk about standard errors. It's looking backwards. Maybe we could just look and see what the current level is. So the return on the market is a combination of the dividend yield of the market plus any expected dividend growth. Now we can go to this website, and I suggest you go to this website if you're watching the video. You can go to this website and you can find out what the dividend yield is for the S&P 500. How do we ultimately then measure and calculate the beta of a company? Well, one of the easier ways, actually, it's not all that difficult, is to estimate beta using linear regression. So here's Cisco companies. The dots here represent the relationship between the stock itself, the return on the stock on a particular day, and the return or the excess return of the S&P 500 on that day. The linear regression or the statistical analysis calculates or creates this line, if you will, and that's referred to as the line of best fit that describes how Cisco relates to the stock market. So the formula we get from this, when we look, here's the market risk premium. There are two variables we're most interested in. Alpha is called the intercept term. The other term, the coefficient here, the other piece of this, represents the sensitivity to market risk. So again, ultimately we're going to have two coefficients that we look for, alpha and beta. Now this E is the error term. If we go back here and look at this, you'll notice that here's the line, but most of these dots are not on the line. So the E, here's November 2002, the E measures the difference between that point and its corresponding point on the line. So this is a line of best fit. It's not a line of perfect fit. So we want to be able to calculate and determine in the end what are these coefficients. So let's again kind of talk about it. If we think that over time, especially if you create portfolios, those residual errors are going to ultimately end up equaling zero. They're going to add each other or sum each other to a zero account. So again, since the errors themselves in a portfolio especially equal zero, the security market line formula says this is what we should see, but there's an error. And again, this error now, since we assume those regression errors ultimately equal zero, this is the risk-adjusted performance of the stock. If A is positive, if alpha is positive, then this stock is performing better than average. If it's negative, it means it's performing below average. And this is just telling us, this alpha is telling us whether the stock is above or below the security market line formula. So if we're given some data for the risk-free rate of return, the return on the individual stock in the stock market, statistical packages can calculate beta. Again, we don't really want to talk about how we do that necessarily, but there are packages that will do that for us. We're going to have an example here where we talk about how you can actually calculate the beta for your company. So again, here's the regression estimates, all right? Risk-free rate's 3%. The market risk premium's 5%. The cost of equity is consistent with a 95% confidence interval for beta. So again, what does that use? If you use the data from 2000 to 2012 and you apply the CAPM equation, the estimated beta of 1.6 implies that the equity cost of capital for Cisco is 11%. But our estimate's uncertain. There's a 95% confidence interval. So in this case, it's going to show us that beta could be anywhere from 1.3 to 1.9. So we're going to have a range in equity cost that ranges from 9.5% to 12.5%. So the cost of financing with equity is somewhere in that range. So how can we do this with our companies? There is a worksheet called Calculate Beta. When you go to Calculate Beta, you're going to gather, or you can gather the prices of the market. In this case, I gathered prices for the S&P 500. And I entered those prices in the yellow boxes here. For the company side, you put your company's ticker symbol in there, and you put the closing or the adjusted closing prices for your company in there. What this ultimately does is we get some calculations, some statistical calculations here. Tells us that the beta for the stock market's around 9.8. We know that in reality that should be 1.0 because it's the market. And it tells us here that the beta of our company is 0.761 is what the calculation is. So now let's actually do the regression. So when you go in, calculate the regression using this, the data that we have here, you're going to regress the stock returns against the stock market returns. And in regression, you get a printout. And the printout provides us with some data. Down here, the intercept, that's alpha, is 0.006. So it's very, very low. Beta is the other coefficient, and the other coefficient is 0.736. So those are our alpha and beta for this company. Now we also have a range, 95%. The beta could be as low as 0.39, could be as high as 1.08. So if we want to calculate the cost of equity for cores, we can use that range of betas. So what will we do? Here's 0.39 is the lower range. 0.761 is kind of go back to where I'm at. Oops, I'm sorry, went the wrong way. The 0.761 is the number that I got up here, right? Got that from the actual calculation in the standing, so it could be 6.92, 10.07, right? We ended up with a portfolio beta could be 0.93, as high as 1.08. So we see here that we can estimate that the cost of equity for cores is somewhere between 6.923 and 12.67. Of course, that's a very high range. There's a lot of numbers in between those two datas. So we have a very wide range of possibilities for the cost of equity for cores. Now, what do we do about the cost of debt? Well, debt yields, the yield to maturity, is essentially the rate of return you get if you buy the stock and you hold it to maturity. If there's very little risk that the company is going to default, then this yield is a reasonable estimate for expected return. However, if there is a chance of default, especially if it is a significant chance, then the yield to maturity is going to overstate the investor's expected return. So it's going to, it's not going to provide us with what the owners actually expect to receive when they buy this bond. So we have some information here in the table. They give us the annual default rates according to the debt rating. So again, on average, a AAA rated bond has a 0% default rate. But a B-rated bond has a 5.5% probability of defaulting. So how do you find out what the cost of debt is? Well, the yield to maturity minus the probability of default multiplied by the expected loss rate provides us with an estimate of this cost. So let's see how we can fit that in. The average loss rate for unsecured debt is around 60%. So according to Table 2, B-rated bonds have a probability of default of 5.5. So the expected return on the average is roughly 3.3% below what the bond yield actually is. So the yield that you would expect to get is whatever the yield is times 0.967, which is 96.7% of what the total yield is what the company would expect. So for cores, I found out that the average yield is 4.122%. So essentially how I did this, I took a weighted average of the yields of the bonds that I found when I looked up the bonds in the when I looked up, like I went to finra.org and investigated my company's bonds. You need to adjust that. Again, the default rate is 0.5%, right? So that's 0.3. So the adjusted yield is the yield of the company. Again, it's slightly off here. 4.122 minus 0.3. So we're going to subtract that out. So it gives us 3.8.22. So this is what I would expect the cost of debt to be for Molson cores. Is there another way that we can do this? Well, maybe we can utilize the capital asset pricing model. The challenge with using CAPM for debt is it's kind of difficult because of the trading and frequency of bonds. Now, we're not going to get to Chapter 21, but it actually shows us a way that we can estimate the debt for bonds. But an approximation is probably just as good as anything else when it comes to calculating the cost of debt here. So if you look at the ratings of bonds, right, a triple B rated bond has an average beta of 0.1. A double B is 0.17, etc. So now we can start thinking, well, okay, how, if I know what the cost of equity is, and now I know what the cost of debt is, if I can calculate those things, I can calculate in the end what we refer to as the weighted average cost of capital. So again, what is the example? How does this work? Okay, we have a home builder, had 6-year bonds, yield to maturity was 6%, and they had a B rating. The risk-free rate of return was 1%, the market premium was 5%. So we can calculate this using the table 12.2 data. So it's 6%. Again, it's times, subtract from that 5.5%, the probability of probability of default, times the loss that's expected, right? The expected loss rate of 60%. So now we end up with a cost of 2.7%. We could use the exact same data though, but use the CAPM information, and that tells us that the cost of debt is around 2.3%. And again, they're very close together, they're very similar. So maybe if we were using this for a company, we'd want to just estimate on average what the cost would be. Now, we can do this for cores to find their debt beta, right? The average risk-free rate we say is about 3.6%. We have an average rate of return on the stock market of 12%. Portfolio beta, because it's a triple B rated bond, is 0.10. So that means that our expected return for the debt on cores is 4.49%. So now we're going to move on. In a second here, we're going to talk about how we utilize these costs to ultimately make predictions.